Hello, I'm David Cassidy with the midweek update for today, Wednesday, the 23rd of June. Well, after last week's hawkish dot plot surprise from the US Central Bank, we said markets were getting way ahead of themselves and it was far too early to conclude that the current economic reflation is over and that we will see significantly higher interest rates in the coming years. And thankfully, common sense has returned this week, allowing global equity markets to reverse last week's losses. While the Fed is going to start thinking about tapering QE, its bond buying program, this is akin to simply removing your foot from a car's accelerator. Tapering certainly doesn't mean stopping QE. In other words, putting your foot firmly on the brake pedal, let alone reversing QE. In other words, selling the bonds that the Fed has previously already purchased. Consequently, the Fed is still going to be pumping massive amounts of money into the economy. It's just that the pace at which it pumps that massive amount of money in will simply be less than it is currently. As a result, we believe that the Fed will keep monetary policy exceptionally loose for the foreseeable future and that the current low interest rate environment is the new normal. Interest rates are very unlikely to normalise at 5 or 10%, and this would be very supportive for equity markets going forward. Furthermore, while testifying before Congress yesterday, the Fed Chair, Jay Powell, reiterated the Fed's view that the current pickup in inflation was transitory and said that the Fed would be patient with any increases in US interest rates, as he correctly downplayed the significance of last week's dot plot. As we've previously stated, the dot plot isn't a Fed forecast, let alone a commitment. It's simply the current view of 18 Fed officials, of which only 11 are Fed voting members. And the changes between March and June dot plots clearly highlight that these 18 Fed officials like to change their mind about interest rates almost willy-nilly. Our focus now turns to the Fed's favoured inflation measure, the core PCE, which is released on Friday, the 25th of June, for signs if the current inflationary pressures are transient or sticky.